Hello everyone, this is E. Dheeraj Kaukunda. Today, we are going to revise a short yet an important chapter, AS2, Valuation of Inventories. If you have prepared thoroughly this chapter would give you a leverage of 2 to 4 marks in your exams. This might be asked in a direct 4 marks question, or it can be a 2 marks MCQ, or it can be embedded into another big question, maybe consolidation or any other chapters. Today, in this video, I'm going to cover different topics that covers definitions and the concept, inclusions and exclusions in the cost of inventory, the special important points with regards to this chapter, and other cases, special cases that requires your attention, disclosures as per the requirement of law, a few examples, and two ICAI study material questions. Without any further ado, let's proceed with the video. Now, let us go through introduction, the definitions and the concepts. AS2 defines inventories as assets held for sale in the ordinary course of business, or assets in the process of production of such sale, or assets for consumption in the production of goods or services for sale. We can say the for sale in the ordinary course of business. We can say this as stock in trade or finished goods. Okay. Now, assets held in the process of production for such sale, work in progress, raw materials, etc. For consumption in the production of goods or services or for sale. Any consumable goods that becomes part of the asset. Now, you see, it includes maintenance supplies, the consumables, as we discussed, loose tools used for production. These words play important role because all such items are used in the production, and the assets excludes machinery spares, servicing equipment, and standby equipment. Why? Because they do not form part of production, hence they are not included in the assets. Examples of inventories are raw material, work in progress, and finished goods, land and other property. If you are thinking about land, can land be stock in trade? Yes, for the enterprises that deals with real estate business, they buy and sell immovable property such as land in the ordinary course of business. That's why land and other property all purchased for resale. Yeah, resale is important. Okay, next. This standard specifically excludes some of the items. Those are work in progress of construction contracts, all such as material direct selling contracts, direct service contracts, sorry, being covered under the AS7 accounting of construction contracts are not covered under the scope of that does not come into the scope of AS2 inventories. But cement lying in the site is covered under AS2 revised. Why? Because cement can be stock in trade or raw material, right? Excuse me. Yeah, can be a raw material, and it is not still embedded into the walls, right? It can be used for another part, so that it is not a part of work in progress, hence it becomes part of AS2 inventory. Now, second item is work in progress of business service providers. That is cost of providing part of service. In case of part of service, if there is any cost that are incurred halfly, and if it is shown as a work in progress, then AS2 does not cover such items, work in progress. Example, in case of shipping company, which is a service of transportation, voyage in progress, such item is not covered under the scope of AS2. Let's say there are fuel, there are lots and lots of fuel, there are lots and lots of stores, they come under raw material, and are covered under AS2, but work in progress is not covered. Then shares, debentures, and other financial instruments held as stock in trade. Person who is into the business of speculation buys, sells shares, debentures, and other financial instruments in the ordinary course of business, but yet these are not covered under AS2. Quick question: are these covered under AS13 revised version, accounting of investments? Answer is no. These are not covered under AS2 revised or AS13 revised. Now, producers' inventories of livestock, agriculture, forest products, mineral oils, ores, and gases. These are not covered under the scope of AS2, but are actually valued at NRV. Why? Because AS2 talks about cost and NRV. Is there any cost relating to livestock, agriculture, forest products? No, that's why it is not covered under AS2. Moving further, important notes in relation to this chapter. Uh, this is a reminder note. We will read this. The cost of closing inventory is a part of cost incurred in the current accounting period that is carried over to the next account period. Whereas the cost of opening inventory is part of the cost occurred in the previous accounting period that is brought forward to current accounting period. What is it trying to say is the closing stock amount which we get in the financial statements are the cost incurred incurred in the current year, whereas the opening stocks, yeah, okay, the opening stock value is from the cost that have incurred in the previous year. Inventories is equal to assets, right? What are assets? Assets are the resources expected to generate future economic benefits, FEV. So whenever you get a chance to define assets, you can write in the exams resources expected to produce future economic benefits. So any costs that are expected to generate future economic benefits through this asset are included in the cost of such asset. Hence, we can say that cost is equal to cost of acquisition and plus cost of acquisition plus cost incurred in bringing the assets to their present location and condition. Why location and condition? If there is any raw material that is brought into the factory, that is brought into the factory, we will add all the freight, labor, etc., which will be discussed further, right? So bringing to the location, all the costs incurred in bringing assets to the present location shall be added, and also all the expenses incurred in bringing assets to the present conditions. What is conditions? Simply costs incurred to convert the material into finished stock, means raw material to finished goods. Costs incurred shall be included simply. Okay, moving further. A question: does the cost incurred to maintain, please pay attention, any cost that is incurred to maintain the inventory becomes a part of cost? Question mark. Does it become? Answer is no. The cost incurred to maintain the inventory, example, storage costs, do not generate any extra future economic benefits. Stock simply lying in the godowns, will they produce future economic benefits? No, and therefore should not be included in the inventory cost, because as per the definition we seen above, expected to generate future economic benefits, right? Now, any storage cost is not included in the cost of raw material, but unless, this is the important part, if such storage cost is necessary in the production process itself. uh, those costs are necessary in production process prior to the further production stage. Example, storage cost of wine or cheese, it takes months, few years. These require time before proceeding to the next process. Hence, it becomes part of the cost. I mean, you cannot directly convert grapes into wine after half an hour or something, right? You need time to process, and that is inevitable. Hence, they should be added. Okay. Next important point is relating to prudence. Everyone remembers the principle of prudence. What does prudence say? No profit should be anticipated, while all foreseeable losses should be recognized. Right? Thus, if a net realizable value of inventory is less than the inventory cost, inventory is valued at net realizable value to reduce the reported profit in anticipation of loss. Why? Prudence concept. You will recognize all the foreseeable losses, whereas you will not recognize any profit that is anticipated. On the other hand, if the NRV of the inventory is more than the inventory cost, the anticipated profit is ignored. Why? Well, because of prudence, and it's then the inventory is valued at cost. In short, everyone knows this from the CA foundation. It is cost or NRV, whichever is lower, right? Now, let us continue. You might be wondering what is accounting standard AS2 and how what does this help us with. Now, to give a short note, we can say that the standard actually specifies what is the cost of inventory. Okay, okay, what are actually then I guess. What are the costs of inventory that can be considered? What the cost of inventory should consist of, and how the net realizable value is determined. Net realizable value is actually determined, right? How it should be determined is specified in this standard. Fourth point is relating to abnormal gains or loss. As everyone knows that abnormal gains and losses are not expected to reoccur regularly. They are abnormal in nature. Yet these values affect the enterprise's performance. So a user of financial statements needs to know the amount of such gains or losses in the current profit or loss. I mean, if you adjust such items in the stock, you would never know that there has been a abnormal situation and cost has been incurred in such regard. So, for this reason, these are shown in the profit and loss statement, and such gains or losses do not form part of inventory. An important point is relating to disclosure. Part 1, Schedule 3 of the Companies Act 2013 prescribes that valuation method should be disclosed for inventory held by companies. Valuation method will be discussed further. Now let us see about the measurements of inventory. Inventories should be valued at lower of cost or NRV, whichever is less. You know that, right? Cost or NRV, whichever is less. But taking into consideration of this standard, let's break down it further. What is cost and what is NRV? According to this standard, cost cost is cost of acquisition and costs incurred in bringing the asset to their present location and conditions. We know that. What is net realizable value? Net realizable value is the estimated selling price in the ordinary course of business, and it should exclude the estimated costs of completion and the estimated costs necessary to make any such sale. Okay, I repeat, the estimated selling price in the ordinary course of business less estimated cost of completion and estimated costs that are necessary to make such sale. To have a comprehensive look, quick chart. Okay, if inventories, there are raw materials, finished goods, and work in progress. Raw materials are valued at cost if finished goods are sold at or above cost, otherwise at replacement cost. Okay. Now, finished goods and work in progress are lower of cost or NRE, whichever is lower, right? And in cost, it may be the cost of purchase, cost of conversion, or other costs. Net realizable value less selling expenses less estimated cost of completion. Next, we will see this with an example. Okay. Now, cost of partly finished unit at the end of 21 to 2011 and 12 is rupees 150. The unit can be finished next year with a further expenditure of rupees 100. What is rupees 100? Cost of completion. The finished goods can be sold at rupees 250 subject to the payment of 4% of brokerage on selling price. What is this? Cost of sale, right? Assume that the partly finished unit cannot be sold in semi-finished form and its NRV is 0 without processing it further. Okay. Now the value of inventory will be determined as below. It is taken from ICAI study material. Let's see. Now net selling price in future is rupees 250 and the estimated cost of completion is rupees 100 and the estimated cost of sale brokerage is 4% of selling price 250, that is rupees 10. From the estimated net selling price, we decrease cost of completion and brokerage of 4%. We arrive at the net realizable value of 140 rupees. Cost of inventory is 150, whichever is lower of cost or NRV, that is 140 rupees. Next, cost of purchase includes duties and taxes that are non-refundable in nature. If there is any GST, ITC, will you be including that in the cost? No, because they are refunded and they are can be used as an input, should not be forming part of cost. Directly attributable expenses, but excludes trade discounts, rebates, or duty drawbacks and others. Okay. Now, cost of conversion. Direct labor cost plus direct and indirect overheads should be forming part of costs. Now, special points regarding to fixed production overheads. This is an important part. Please pay more attention. Now, firstly, we'll try to get an understanding of normal capacity. Normal capacity is the production the enterprise expects to achieve on an average over a number of periods or seasons under normal circumstances, considering the loss of capacity resulting from planned maintenance. I mean, will the enterprise considers any loss because of a loss of capacity resulting from planned maintenance? Means yes, it will consider the cost and then it will make an expectation, that is enterprise expects to achieve an average. Okay. Now question, can normal production, the expectation, and actual production reality be different? Answer is yes, they can be different. Also they can be over or under production. Let's understand this concept with examples. Now, ABC Limited has a plant with a capacity to produce 1 lakh units of products per annum, and the expected fixed overheads to be 18 lakhs. Fixed overheads on the basis of normal capacity can be calculated as rupees 18 lakhs divided by 1 lakh is rupees 18 per unit, right? Now, let us consider the scenario 1 where the total production is less, that is underproduction. If the actual production is 90,000 units, which is less than 1 lakh units, then per unit overhead is rupees 20. How did you arrive at this? How did you arrive at this 20 means? That is 18 lakhs divided by 90,000 units, right? Rupees 80 lakhs divided by 90,000 units is rupees 20 per 1 unit. Had the enterprise produced normal output, the cost would have been rupees 18, and the cost for 90,000 of units in that case will be 90,000 units into 18. That is rupees 1 lakh, that rupees 16 lakhs 20,000. But here the enterprise has spent an additional expense of rupees 18 lakhs minus 16 lakhs 20,000. That is rupees 1 lakh 80,000, which has happened due to the failure of the enterprise to produce the normal output, right? Hence, this 1 lakh 80,000 difference should be transferred to P&L account, while the 16 lakhs 20,000 of fixed overhead becomes part of the cost of inventory. Now, scenario 2, overproduction of material. If actual production is 1.2 lakhs, which is greater than 1.2 lakhs, which is greater than 1 lakh units, the enterprise cannot say that rupees 18 per unit will be charged and the total cost will become 21 lakh 60,000, right? Like, yeah, I mean, if we have decided that rupees 18 is charged for every unit, don't you think the total becomes 21 lakh 60,000? Is it a really fixed overhead cost? No, it is only 18 lakhs. That's why here the enterprise includes fixed overheads on actual basis, that is 1.2 lakhs into 15 rupees per unit. How did you arrive? Simply 18 lakhs is the actual overheads incurred, while 1 lakh 20,000 is the actual output that has obtained. Now we take this two threes is 15 rupees, right? That's what. Next, joint or byproducts. In case of joint or byproducts, the costs are incurred up to the state of splitting, right? Should Now splitting off should be allocated. Okay. In case of joint or byproducts, the costs are incurred up to the stage of splitting off should be allocated on the rational and consistent basis, which is usually the sale value. Sale value of output. Special caution should be paid. It is a sale value but not sale price per unit. Okay. Now, the basis of allocation may be the sale value at a split off point. For example, value of byproducts, scraps, and wastes are usually not material. These are therefore valued at net realizable value. The cost of main product is then valued as joint cost, total cost, minus net realizable value of this byproduct, scraps, and wastes. Now, other costs. There are other costs that can be incurred in the furtherance of business, and some of them become part of the cost while others not, such as cost of design. Custom made design expense or modification in the asset to bring it to some condition or location, expected condition location of decided by the management, becomes the part of cost. Okay. Then, if the interest and other borrowing costs usually considered as not relating to bringing the inventories to the present location and conditions, right? Our interest becomes important part of a part of bringing the inventories to the present location and condition. The answer is no. That is why they do not form part of total cost. But there is a case. But such interest can be included if inventory necessarily takes substantial period of time for getting ready for the intended sale. Example of such thing is wine. If there is any interest paid for the production of wine, then such interest can be forming part of stock. Then amortization of intangibles. Standard is actually silent on such treatment, but it appears that amortization of intangibles related to production that is production patents, right of production or copyright of a publisher should be taken as a part of inventory costs. And lastly, exchange differences are not taken into inventory costs. Exclusions from the cost of inventory. These are four important points that might be asked directly in the exam. One, abnormal amounts of wasted materials, labor, or other production costs, which are abnormal in nature and shall be part of profit and loss and cannot be considered in the cost of material. Next, storage costs do not form part of raw material unless the production process requires such storage, as we have discussed above. Administrative overheads that do not contribute to bringing the inventories to their present location and condition. It is defined under the definition of asset. If any costs that do not contribute to bring the inventories to their present location and condition, such expenses shall not become the part of cost. Selling and distribution costs do not form part of cost of inventory. Now let us discuss about the cost formulas in AS2. Now, in cost formulas, if any specific identification is in the process, like if there is the management has defined a system, or there is a specific identification process of each items of the stock, then such specific identification is best whenever there is possible. I mean, if there is a established system in operations that identifies each and every item separately, then the cost formula is the same system. In all other cases, the cost of inventory should be determined by the first in first out, as you have learned in CA foundation, first in first out method or weighted average cost formula. The formula used should reflect the fairest possible approximation to the cost. The intention is the formula used should reflect the fairest possible approximation of the cost of what business. Now there are special cases in valuation, that is, instead of actual, the standard costs may be taken as the cost of inventory, provided such standards are fairly approximate to the actual and regularly reviewed for revisions. What about about the standard cost? You can learn this in the subject of costing, right? Now, another case is the retail business. Now, if a large number of rapidly changing items are traded, the actual cost of items may be difficult to determine. However, they are usually sold at similar gross margin. Hence, the cost of inventory is determined by reducing the sale value of such unsold stock at the end of the day or a year by approximate average percentage of the gross margin. To understand this part betterly, we will go through an example. Now, let's say a roadside vendor is selling lots and lots of items in his truck. You are required to assess the value of stock here. Okay. Now, all the information you have is as follows. Opening stock is rupees 20,000, and he has purchased morning 30,000 of worth of stock, and then he sold during the day is of rupees 45,000. Now, average percentage of gross markup. Now, you understand the word markup, right? Markup is used on cost. 20 is 25% on the cost. The cost of closing inventory can be calculated as follows. How? The sale value of the opening stock plus purchase stock. What is it? Now let's determine the cost of closing inventory. How is it determined? First, we will see the total sale value of the stock. What are the stock available with us? That is opening stock and the purchase stock, right? So 20,000 plus 30,000 is the cost of both stocks. And what is the sale value? You will increase it by plus 25%, or you can simply multiply it with 1.25 like this. You will get 62,500. I mean, total stock worth of 50,000 should be sold at 62,500. But how much worth of stock is actually sold means 45,000 rupees are actually sold. Now, sale value of the unsold sale value. Notice, sale value of the unsold stock is 17,500. Now, 17,500 is the sale price. To arrive at the cost price, we can think this as this amount is divided by 125, and what we need to arrive, at the 25% part. So we multiply it by 25 by 125. This is wrong. Okay, that is equals to 3,500. This is the gross profit, or simply is margin, 25%. Then the cost of inventory becomes 17,500 minus 3,500, that is 14,000. An important note, margin is on sales, whereas markup, this is actually markup is on cost. See, even I made mistakes, so make sure that you remember this point. Now, third important point is estimates of the net realizable value. Now, realizable value is a foreseen. There is foreseen loss, then the net realizable value becomes less than that is to be recorded, like cost or NRI, whichever is lower. So it depends on estimates, right? Now, estimates are based on the most reliable evidence available. These estimates take into consideration the fluctuations of the price or cost directly related to the events occurring after the balance sheet date, to the extent that such events conform the conditions existing at the balance sheet date. Okay, now this might be a little elaborating, but I'll try to compose this for you. Now, let's take two scenarios, A and B. As in A, the value of stock as on 31st March is rupees 100. But a news and there is a new government circular in circulation that government has put a restriction on sale value of such goods to rupees 80. So the estimates here are from the most reliable evidence available. And the thing is, there is a foreseeable loss. Circular bill is yet to be passed, or it should be made in houses, parliament, or something. So this is now after 3 months, now April, May, and June, July 1st arrives. As on July 1st, the bill is passed, and the cost are said to be lowered to rupees 80. Now, tell me something. As on 31st March, is there any condition of such foreseeable loss in relation to the stocks? Answer is yes. Um, but the event has been confirmed after the due date, sorry, after the closing date. But yet, the cost should be measured on 31st March, right? Which amount will be should we take? Should we take 100 or should we take 80? The answer is 80. Why? Because these estimates take into consideration the fluctuations of price or cost directly relating to events occurring after the balance sheet date, to the extent that such events conform the conditions existing on the balance sheet date. So if there is a condition existing on balance sheet date that says, yeah, there might be a chance that rupees 20 should be decreased, then only if such event occurs in the future, we will reduce the stock to rupees 80. Another case scenario is B, which is as on 31st March, the stock is rupees of 100. Same in July 1st, a war broke down, and the supply demand got fluctuated, and the rupees had fallen to 50 rupees. Now, can I say like no, 50 rupees? No, I have half. I have the half stock unsold on as on 31st March in my inventory. Then I should decrease the stock to rupees 50. Should I? Can I say that? The answer is no. Why? Because no such conditions actually exist on the balance sheet date. Is there any condition that says as on balance sheet date that there is a war going to happen in July? No. That is why such adjustments are not to be made in the cost. Then, NRV of materials held for use or disposal. Materials and other supplies held for use in the production of inventories are not written down below the cost if the selling price of the finished product containing the material exceeds the cost of finished product. To give a comprehensive idea about what this is saying, I can give you an example. Like example, now there are grapes. Good example. GRAPS, grapes. Now the grapes are the cost of rupees 100 per kg. Okay. Now our business is wine business. We will convert this into wine, and we will sell this for rupees 250. Let's say, I don't know the cost of wine, by the way. Next, there comes an event where grapes price will fall to rupees 80. Now, should I decrease the stock to rupees 80? Well, answer is actually depends. What is our finished goods? The finished goods is wine, and according to our estimations, the wine's NRV, net realizable value, is 250 or more. That is cost or more. If the cost, it is cost or more, should will we evaluate NRE? No, we will evaluate cost. That means the enterprise, even if there is a fall in price of grapes, it can still use such grapes in the finished products and sell such finished products at cost or more. In such case, what is the need of undervaluing such raw material? That is the reason. Now it might make sense if you read this again. NRV of, let me clear this for you. Now, okay. Now, NRV of materials held for use or disposal. Now, materials and other supplies held for use in the production of inventories are not written down below the cost if the selling price of the finished goods in which these inventories are used, okay, if the selling price of finished goods containing the material exceeds the cost of finished product, actually it meets or exceeds the cost of finished product. Okay, now proceeding further, the disclosures part of the in disclosure part of AS2. The financial statements should disclose the accounting policy adopted in measuring the inventories, including the cost formula used. Remember, the first in, first out, or weighted average, or retail method, or standard. Is there any standard method or any specific uh, methodology that is made, which gives a precise or more reliable information relating to the raw material? Okay, next, another thing financial statements should disclose is the total carrying amount of inventories together with the classification that is appropriate to the enterprise. What are such classifications? What? Raw materials and components. I mean, what should it disclose? It should disclose the raw materials and components, work in progress, finished goods, stock in trade in respect of goods acquired for trading, that is finished. These are finished goods, but stock in trade, we don't make any changes inside. These are both finished goods and raw materials, whatever you can say. Stores and spares, loose tools, and other if any specific nature should be disclosed in the financial statements. Now let us proceed with the practice problems. I have two problems for you. The first question, X Company Limited purchased goods at a cost of rupees 40 lakhs in October 2011. Till March 31st, 2012, 75% of the stocks were sold. The company wants to disclose the closing stock at 10 lakhs. Is it true? Yeah, 40%, 40 lakhs, 25%, 10 lakhs. The expected sale value is 11 lakhs and a commission of 10% on sale is payable up to the agent. Advise what is the correct closing stock to be disclosed as on 31st March 2012. As per AS2 revised valuation of inventories, the inventories are to be valued at lower of cost or NRV. We know the cost. Here we know the cost is equals to rupees 10 lakhs. Now we should find what is NRV. As per the formula, NRV are net realizable value estimated minus any cost of completion minus any cost of sale, right? Taking that into consideration, in this case the cost of inventory is 10 lakhs while the net realizable value is 11 lakhs into 90%. Why 90%? Yes, 10% commission on sale value. What is a sale value? Can be sold at 11 lakhs. So 11 lakhs into 10% will be 1.1 lakh. That employs NRV is equals to, let me write it down. Yeah, 11 lakhs minus 1 lakh 10,000, which amounts to 9. 10 minus 1, 9 lakhs 90,000. So the stock should be valued at whichever is lower, 9 lakhs 90,000 or 10 lakhs, whichever is lower, that is 9 lakhs 90,000. Okay, next, proceeding further. Second question. Now, Mr. Mehul gives the following information relating to items forming part of inventory as of 31st March 2011. His factory produces product X using raw material A. Now, 600 units of raw material A purchased at rupees 120 are there. Now, the replacement cost of raw material A as on 31st March 2011 is rupees 90. If you remember correctly, the chart, the raw material should be valued at cost or cost. Also condition if the finished goods can be sold at cost or more, and raw material should be valued at replacement cost if this condition does not exist, right? Next, 500 units of partly finished goods in the process of producing X, and the cost incurred till date is rupees 260 per unit. These units can be finished next year by incurring additional cost of rupees 60 per unit. Why is this matters? Because it will be used in calculation of work in progress. It should be, and specifically it will be used in calculation of NRV. And 1500 units of finished product X exists, and the total cost incurred is 320 per unit. Any further information? Yes, the expected sale price of the product X is rupees 300. What is happening? Expected price is falling. That means net realizable value of the finished goods is falling. Determine how each item of the inventory will be valued as on 31st March 2011 and calculate the value of total inventory as on 31st March 2011. I'm going to, I have to go through this. Please bear with me. As per AS2, valuation of inventory, write this if you are certain about your standards, it makes the examiner feel good. Okay, next. As per AS2, valuation of inventories, materials and other supplies held for use in the production of inventories are not written down below its cost if the condition, the finished products in which they are incorporated are expected to be sold at cost or above cost. Remember the grapes example. Grapes example. However, when there has been a decline in the price of materials and it is estimated that the cost of the finished goods will exceed NRV, that is NRV, the material are written down to NRV. Now I have to, okay, let's continue with this same question. I will explain with another question later. In such circumstances, the replacement cost of the materials may be the best available measure of their NRV. In the given case, the selling price of the product is 300, whereas the cost is 320. And the total cost is 320, right? Hence, the valuation will be done as below. 600 units of raw materials will be written down to the replacement cost by 300 rupees NRV is less than 320. As the market value of the finished goods is less than its cost. Hence, the value rupees 90 per unit. What is 90? Replacement cost of raw material. Next, 500 units of partly finished goods will be valued at NRV, that is lower of cost, which is 260 rupees, or NRV 240. How it is arrived? Estimated selling price, estimated NRV is 300 minus additional cost, cost of completion is rupees 60, that is equals to 300 minus 60, 240. Now the NRV is 240, cost is 260, whichever is lower, 240. 1500 units of finished products of X will be valued at NRV of rupees 300 being lower than cost 320. Comprehensive table can be seen now. The raw material A units are 600. Cost is 120. And for work in progress and finished goods, we use NRV, whereas for raw material, we use replacement cost. Replacement cost is 90, whichever is lower, that is 90 into 600 arrives at 54,000. Cost is 250, whereas NRV is 240, whichever is lower, 240 into 500 arrives at 1,20,000. 320 is the cost, NRV is 300. 300 into 1500 arrive at 4,50,000. Add 1000, 5, 6, 7, 5, 5, 10, 24, 24, 4, 5, 6, 6 lakhs, 40,000. So this was a quick review of AS2 valuation of inventories. I hope you got a good awareness regarding the points. So thank you for listening, and if there is anything, any doubt in this regard, you can let me know through the comments. Have a great day.